This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we've got a chapter here all about the presentation of your financial statements, so governed by IAS 1. I'm sure you're all happy with the contents of what appears within a set of financial statements. So your position statement, your performance statement being your profit or loss and other comprehensive income, your statement of change in equity, statement of cash flows, but don't forget as well that you've then got the notes of the accounts and then the comparative information as well. Okay, remember the comparatives are there to help the comparison from year on year. That's obvious, isn't it? But goes back to your comparability, doesn't it, within the framework? Okay, so that the user of the accounts can see how the business has performed from one year to the next, and also look at the changes in the resources that it controls and the liabilities that it owes. So again, linking back to some of the definitions that you have within the framework. So I don't think there's anything new within there that you'd be unaware of. When I was putting the notes together for SBR and changing it from when it was there in the glory days of P2, it's like, well, is this chapter necessary? Because, you know, in P2, you had to prepare a set of group accounts, didn't we? So either the position or the performance statements or looking at your cash flow statements, whereby now in strategic business reporting, you don't have to prepare the full set of financial statements, do we? Okay, you don't have to prepare a group statement of financial position. You don't have to prepare a group performance statement, and you don't have to prepare a group statement of cash flows. Okay, you're going to have to prepare extracts from each of them and put in some discussion elements as well. So I thought about taking it out, but then I thought, no, you know, you've got to get the overall big picture, haven't we? You know, if we're working it through, we've taken the framework, haven't we, which is like the overall big picture and the fundamentals of how everything is pieced together. And then the next bit really is IAS 1, isn't it? Your presentation of financial statements. So that's important because that then governs what you then see from each of the individual IFRSs, IASs, and also as part of group accounts. So I thought, yeah, let's leave it in. It's relevant, it's useful. And as we go through, we can just recap bits and pieces as well, very briefly from F7 or as it's now known, financial reporting. Okay. One small point to note, remember now under this strategic business reporting paper, the second question in section A will contain ethics. Okay. Now, the ethical scenarios that you usually get within the exam are that you have to look at the accounting aspect and then comment upon the ethical issue. And the scenario usually arises, particularly what we've seen in the past under P2 and what we're likely to see going forward in strategic business reporting and what we've seen in the specimen paper, is that you have somebody, whether it's a director or it's an accountant, that has not applied the rules of the IFRSs. Okay. And by not applying the rules within the IFRSs, you're then effectively not showing a fair presentation of the results. And if you're not showing a fair presentation of the results, then you're going against not just the rules in the standard, but also IAS 1. Okay, so therefore you are acting unethically because you should be preparing those financial statements based upon your international financial reporting standards. That brings in the ethical aspect, doesn't it? And we'll see ethics much later on within the class notes. But just be aware that you need to follow all of the accounting rules. If there's no particular accounting standard, then use the rules within the framework to be able to go through there and present fairly the results of the entity, okay, the performance, and also presenting fairly the resources that it controls and the liabilities that it owes. Okay. So let's just go back and have a look at the statement of financial position. I'm sure you're all aware and can remember that it's a snapshot in time. So it is as at that point in time, isn't it? So which is why when you have your group accounts and you consolidate as at that point in time. You look at all of the assets and liabilities of the parent and of the subsidiary. Okay, and you add them together line by line, don't we? Remember, your statement of profit or loss tells a story throughout that 12-month period up until that reporting date, isn't it? So therefore, that then means, remember, when you're looking at consolidation of a subsidiary and there's been a mid-year acquisition, that's why we then prorate the results of the subsidiary to show the period whereby we have actually had control. Okay. But going back to the position statements, so remember, you've got your assets on the top, the equity and liabilities on the bottom. So the assets at the top are all those resources that we control. Or you have the rights to go through there and get the benefits from. So you've got property, plant and equipment, so land and buildings, motor vehicles, fixtures and fittings, etc. Remember, your property, plant and equipment is carried at carrying value, isn't it? Based on your historic cost, so cost less accumulated depreciation. And you can apply the revaluation model, can't we? So you revalue it periodically up to fair value. So when there is a material change in the fair value, you will process that within your accounts. Again, coming back to the framework, we are only interested in material amounts, aren't we? So therefore, if it's an immaterial change in the fair value, we do not process it. Okay. Property, plant and equipment is one of the first accounting standards that we get to look at when we get to the accounting standards. So we begin to look at IAS 16, property, plant and equipment, and then we bring in other aspects as well, such as government grants, investment property, which would actually be a separate line to property, plant and equipment, and borrowing costs as well. Okay, all of which you've seen in the glory days of financial reporting. Intangibles. So that's, if you're coming into group accounts, that's where your goodwill would appear, isn't it, as an intangible non-current asset. But don't forget, that's where we begin to see your research and development. So remember, research is expense, development costs, if they meet the criteria, are capitalized and amortized when they are there generating the benefits that you expect them to. Okay, so when it's ready to be put into use. Okay, don't forget as well, you've got those separately purchased intangibles. So if you go through there and purchase a patent, a license, you can capitalize it and then amortize it over its useful life. Okay, if there's no useful life, you do annual impairment reviews. You then got financial assets, so that appears twice. It can be a non-current and it can be a current asset, again depending upon when you intend to liquidate that financial asset. But the financial assets that you're looking at are investment in debt and investment in shares. Okay, so that's when we'll recap fair value through profit or loss, fair value through OCI, and is it there your amortized cost? Ooh, yeah, amortized cost, remember that. Inventory, lower of cost than NRV, cost formula, FIFO, LIFO, weighted average. Sound familiar? Fine. Receivables, again, we'll advance that a bit further. Advancing receivables, yes, because we begin to look at the impairment on your receivables. Receivable is a financial asset, so impairments of financial assets encompass the impairment of a receivable, so effectively your allowance. And then just towards the bottom, after your total current assets, you've got your non-current assets held for sale. So remember, that's IFRS 5. That was quite complex, quite tricky, so we'll need to recap that, won't we? And look at how we hold that asset that you are intending to sell within the next 12 months. What its value is within your accounts, in your current assets, and what the subsequent treatment of it therein is. Okay. If I'm going a bit quickly, don't panic. We'll do it all in a lot more detail as we get through to each individual chapter. It's just an overall summary. Equity and liabilities, there's nothing too exciting there, I suppose, apart from this other component of equity that you see more of at strategic business reporting level than what you saw at financial reporting. Other components of equity are all your other reserves other than retained earnings. So share premium, revaluation reserve, gains or losses on fair value through other comprehensive income, financial assets, what effectively you've seen so far. Okay, there'll be other bits that appear within there, but I'm not too worried about it for now. Liabilities, you've got a good one there in terms of your deferred tax. Okay, deferred tax going in your non-current liabilities. Remember the steps: working out the tax base, then working out the temporary difference based on those tax bases, applying the tax rate to the tax base, looking at the movements to go through there and work out the movement in deferred tax, going to profit or loss and OCI. Oh, stop! Yeah, that's way too far. There's deferred tax that you'll need to recap within strategic business reporting. It says finance lease liabilities. I will correct that. Finance leases don't exist anymore under lessee accounting, but we do have a lease liability within there. Okay, just not called a finance lease liability. So I will correct that when I get the chance. You've got other bits and pieces that are in there. Your tax payable, which will then be linked into your tax chapter. Dividends payable and trade and other payables. Okay, your long-term borrowings again. Part of your financial liabilities held at amortized cost. Okay. Statement of profit or loss. I don't think there's anything exciting within there. Everything's exciting. What am I on about? Okay. Anything to note is what I should say. But remember, you need to split that into your continuing and discontinued operations under IFRS 5. So one of the more recent disclosure standards. I say recent, it's quite old now. Okay. But you've got other disclosure standards as well as just IFRS 5. You've got IFRS 7 on financial instrument disclosures, IFRS 8 on operating segments. You've got the as well, is it IFRS 12, which is looking at your investments in other entities and the disclosures that you need to make there. So a lot of the recent standards, apart from the standard on leases and revenue, which are big ones, and financial instruments, a lot of the recent standards have been revolving around disclosure, okay, to giving the users of the accounts more information. Do they need more information? I don't know. I think they've got enough, okay, but there's some standards on disclosure there. Anyway, I'm getting off track just a little bit. But for the statement of profit or loss, other comprehensive income, the way in which profit or loss works effectively is like anything that's been realized, isn't it? Other comprehensive income is anything that's stored up and has yet to be realized, but will be realized at some point in the future. Okay. Bits to do with your other comprehensive income. Remember, in financial reporting or F7, you only really looked at items that will not be reclassified to profit or loss. So you've seen in FR the gain on non-current asset revaluations, the gain or loss on fair value through other comprehensive income investments that you have. So remember, when they are realized, if you like, that is done via some form of reserve transfer through the statement of changes in equity. So that will be here. Okay. So remember, the transfer to retained earnings for your excess depreciation takes the excess depreciation from your revaluation reserve in your other components of equity and puts it back into your retained earnings. Okay. Again, we'll see that in more detail in the PPE chapter. There are then some newer aspects. Not least, there are items that may be reclassified. So you've got this exchange difference on a foreign subsidiary, which you have no idea what that is at the moment in time. But any exchange differences there can then be recognised in the future in profit or loss when that subsidiary is disposed of. So instead of doing a reserve transfer, the gains or losses are transferred up to profit or loss. Similarly, for something to do with cash flow hedges as well. Okay. The only other item that you've got that is new. So again, these exchange differences are new. The hedging is new. And then we've also got a little bit on pensions as well that is new. But the bit on pensions that you have cannot be reclassified through profit or loss when that pension liability is extinguished. Okay, there we go. Excellent. The statement of changes in equity. I've mentioned the key one already, haven't I? That transfer to retained earnings of your excess depreciation or the gains that have been stored up from your fair value through other comprehensive income financial assets. Statement of change in equity. It is what it is. It's a statement that shows you the changes in equity. So you've got equity shares, retained earnings, and other components of equity. You're not going to have to prepare it. Okay, it's not financial reporting. You just need to look at what the movements are. So on equity shares, you've got issues of shares, so new issues, rights issues, bonus issues, maybe even a share repurchase. Then in retained earnings, you've got your profit figure. So this figure here is your profit for the year, isn't it? That you add the retained earnings and then you deduct the dividend to get your carry forward figure. And then you've got your figure from the other component of equity. So going back to where we were before, your other comprehensive income figure there, net of tax, goes to that statement of change in equity. And then your profit figure, again, goes to the statement of changes in equity. Can you see that? Is it just there? Okay. There you have it. Excellent. So that's just a quick recap of bits that you've seen, bits that you've forgotten, shall we say. That's usually the case. Don't worry, it all comes flooding back to you very, very quickly. You're not going to have to prepare any of these financial statements, but I do think it's useful to have a working knowledge of them. Okay. And just merely stating where something goes will get you credit in terms of the explanation. By stating that your goodwill is an intangible non-current asset on the statement of financial position, surely that has to give you credit. It's correct. Okay. Stating that the non-current asset held for sale, where that is positioned within the SFP, so after the current assets as a separate line item. Okay. All valid, all relevant. You'll be good at the calculations. It's the explanations that will be the more tricky. So the more that you know, the easier those explanations will become.